Okay, once again, welcome to the second session of our stock market, or let's say investment uh, class. The objective of this coaching or training session is to get us more comfortable and familiar with investing in the stock market. You know, we don't know it all, but the little that we know, it's can be enough for us to get ourselves on a positive trajectory. So, last session, the first session, we talked about the stock market in overall, understanding what stock market is, how did it all start, and what we can expect in that space. But today we will start from another dimension, which is actually going deeper into analysis now. But before I go into what I have put together, I want to do some few housekeeping. Let me start by saying that the session is not for, it's not to turn you into an accountant or a financial analyst. Although I know we have one or two accountants on call, you know. So it's your terrain. So you'll be a little more at home with some of the things that we're going to discuss today. But for those that are not accountant or financial analyst, it's also very good because it's going to help you in your businesses and in your engaging generally with your investment, because investment or investing in stock is like owning a part of that business. So you're actually a business owner, although a passive business owner. So it is important for you to understand what fundamental analysis is. So, like I said, is to stimulate your interest. You still going to continue to learn, but once you have a good understanding of framework of what you have to look out for, then it becomes very easy to run such analysis. The second point I want to highlight is that there is a difference between an investor and a trader. They operate from two different philosophies and two different mindsets. As an investor, you are looking at a long-term approach. You are taking a position in the business as part of the owner of the business. So you are very much concerned about every dimension of that business, everything that is happening in that business. It's even from a trader that is just looking for a quick turnaround. He wants to make money, whether daily, weekly, monthly, yearly, but most times they operate on a very short horizon. So they have different approach to investment. When we get to the session three, we'll be talking more of the approach of a trader. But today, our focus is on the approach of an investor. And an investor must understand everything about the business. You are a part owner of that business. And if you have put your hard-earned cash from other income sources into the business, I would think that it's better for you to understand what they are doing. Otherwise, you can just use your money to enjoy life and move on. The third thing I want to highlight is the importance of AI. Now we are in the AI generation, so everything practically can be Googled or can be run through AI. So AI has become a powerful tool that we can use in running our analysis. It can give you quick analysis. It can help you to do computation. So some of those computation that my accountant friend here will take hours to run and to do. Now these days with AI, you can easily do it. But however, I have to send a note of caution around using AI. AI alone is not sufficient for you to run your investment. And I don't think there is any AI tool out there that will not put a caution around the data that they are churning out. Because you cannot want to invest 1 million, 2 million, 5 million, 10 million, 50 million, 100 million, 1 billion and commit it to AI. Just imagine you putting all your life savings into one machine that you don't understand what is turning together. So because of those fiduciary responsibilities that AI cannot take, you will hardly see any AI generative machine telling you to invest in a particular stock or not. You can try it, ask AI if you should invest in a particular stock. It's going to give you a very conservative response, and it will tell you to go and consult your financial expert because our situations are different. Conditions can change from time to time that AI might not be able to catch, and you cannot hold AI responsible that it is because AI told me to invest in this ABC company, and the ABC company went bankrupt, so I have to sue the AI company. No. So that means that we have to figure out an approach that is very useful. And one of the approaches that is being advocated is what they call exoskeleton approach, where you can run your data analysis with your AI because of the computation power, but you have to marry the decision with your human judgment. And that is why it is important for you to understand what fundamental analysis is all about. What are you looking for? What do you want to prompt AI to give you? And how do you want to build everything together into a complete story for you to now drop your money and put your money where you think it will give you maximum return? So I thought of highlighting all those before we go into the presentation proper. It's going to be very useful using AI, but don't rely only on AI to make your decision. Okay, having said that, let me start by asking a question. Do you think your investment? I know most of us here we have invested in different stock market, right? Different companies. We have investment in banks, in FMCG, in other transportation logistics companies like NACO and the rest. Can you confidently say that the businesses you have invested in, they are good businesses? Can you say that they are good businesses? That's question one. The second question is, can you confidently say that they are good investments? The fact that they are good businesses does not mean that they are good investment. And the fact that they are good investment does not also mean that they are good businesses. They can be both. They should be both. But you have to understand the story around each company to determine whether they are good businesses and they are good investment. So fundamental analysis helps you to check if that company is a good business. If that company is a good business. So if it's not a good business, then you can determine the amount of risk or the level of risk you want to take, or if you want to even invest in it at all. So we're going to be looking at all that as we go today. By the end of this session, I expect that you'll be able to say with some level of confidence, or when you do your homework, that okay, I have businesses that I can say they are good businesses and they are also good investment. Okay. I think I will wait to the end of the session to entertain any questions so that I don't slow us down. I hope that is okay by us. You can just give me a thumbs up if it's okay. All right. So what we're going to be looking at today, we have about 8 cards to go through. The first is what is fundamental analysis. Then we look at types of fundamental analysis, uh, which are quantitative analysis and qualitative analysis. Then we go to the financial statement. Um, then we do fundamental analysis framework. We create a framework for our analysis. Then the fifth is then we're going to analyze the company, analyze the industry, analyze the economy. Then we have a kind of comparative framework or summary of how to go about our analysis. So these are what we are going to address this evening. And I'm very sure at the end of this session, if you go back and take time to do what we are going to, the framework we're going to create here, and you apply it to each of your stock, it's going to be a lot of work. But once you are able to apply it to it, then you'll be confident about your investment. So let me start with what is fundamental analysis. So fundamental analysis, as I put on the screen, is to evaluate a company intrinsic value. It's basically to understand, one, what the business is all about. Is it a good business? Is it undervalued? Is it overvalued? What is it all about? Now, a trader is not really concerned about what the business is all about. He's just concerned about the price movement of that product or that stock that day, whether the stock is selling sand or selling stone or selling, he's not bothered. A trader is not bothered about all that. It's bothered about the movement in the price. When we get to technical analysis, we're going to talk more around that. But for a fundamental analyst is like part owner in that business. So he's very interested in everything about the business. Imagine you starting a business, right? You are not just going to be interested in what the price of your product is. You're going to think about your human resource. You're going to think about your warehousing. You're going to think about your, supply chain. You're going to think about your operations, your management, your location. You're going to look at the entire business as a whole. And that is fundamental analysis. That's what you're actually doing when you're doing fundamental analysis. And for you to be able to do that, you want to look at, because you are not in the business now, you can't walk into Zenith office tomorrow morning, for as an example, and say, oh, I want to know this, I want to know that. No. However, they have given you a sort of window into the operation from which you can now start to run your analysis and make a sense of what they are doing. So you will be looking, as a fundamental analyst, you will be looking at their financial statement. You will be looking and querying their business model. You'll be looking at their industry position, and you'll be looking at the macroeconomic environment. So these are the 4 areas as fundamental analyst you have to be concerned about. You have to be familiar with the financial statement, which you will see in their annual report. You have to be familiar with their business model, which you will also see in their annual report. You will see it on their website, and you will see it in the general business literatures and publications that will be going around. And you want to know what is happening in that industry and the macro environment, which is the whole country now in this respect. What is happening with the CBN, with the regulators, with the government, the direction of things, and all that. So, as a fundamental analyst, those will be your area of concern. So, anyone that is using all this data to make decision, we actually refer to them as an investor. It doesn't mean that a trader is also not an investor, but it's just that their kind of investment is different. It's short term. A fundamental analyst or an investor will be looking at a long term approach. We'll be looking at a long term approach, right, to their investment. So, what are the 2 types of analysis you will do as an investor? The first is quantitative analysis. For those that are not very comfortable with numbers, AI will help out in that space. But for those that are very comfortable with number, you can do some computation yourself. You can validate whatever AI is going to give you. But quantitative analysis is about measuring the data, the numerical data coming from their reports, things like revenue, profit, cash flow, balance sheet strength, financial ratios, growth trend. Those are the things that you want to be comfortable with the company that you are investing in. If you are an investor, you want to be able to have some level of confidence around these numbers. But the other side of it is also the qualitative analysis, where you now start to look at what is their management quality, what is their brand strength, the goodwill, what is their competitive advantage, what is the industry conditions, what are the regulatory environment like, and this will play a lot of, we give you a lot of input into your sentimental analysis as well. When we get sentimental analysis, we're going to look at all that. But as a fundamental analyst, you want to have these 2 pictures, the quantitative and the qualitative picture. You want to know their numbers, and you want to know their culture, their organization, their behavior, and their position in the market. Now, so I mentioned that one of the tools that you will need as a fundamental analyst is the financial statement. And therefore, it is very important for us to understand the structure of a financial statement. There are different formats, different approaches to preparing a financial statement, but they are all consistent in what they have to report, guided by some international financial reporting rules. So they are not just going to prepare it based on what they like. So you can be sure to see the same structure across all companies, but it might be giving you different information or behaving based on their business model. So we're going to look at we're going to check what asset is, liability is in the balance sheet, what are the principal elements in income statement, um, uh, what is cash flow all about. Going to look at concept around depreciation. If you have been listening to news, you'll be hearing things around depreciation, impairment, and all that. What does it mean to you as a fundamental analyst? There are some basic things you have to be comfortable with, or you have to be familiar with as a fundamental analyst and as an investor. All right. The last part, I won't go too much into that. That is looking at accounting for inventories, since we are not going into accounting details. But I'm just going to mention some points in that respect. So let's start with the financial statement. Let me ask a question here. How many people or how many of us have read a financial statement before, or you are comfortable with financial statement? Just give me a thumbs up if you have taken time to look at any financial statement before. Right. So do we understand every aspect of this financial statement? How many people understand every aspect of the financial statement? Just a pause check before we move forward. If you are very comfortable with financial statement, just give me a thumbs up so that I can know that, okay. Um, all right. So I know some of us are accountants, so we cannot deny that understand financial statement. But I'm just going to explain things in a very simple way. I do take classes for non-financial managers. So I try to kind of demystify and remove the technicalities around what you see in the books so that we can all be familiar with it. It's very simple. So we start with the balance sheet, you know, and balance sheet from its name, it has to be balanced. That is, it cannot be imbalanced because it's a balance sheet. Now we call it statement of financial position. It's the same thing whether they put it as balance sheet or they call it statement of financial position. What we are simply saying is that everything about the company, their asset, their liability, everything about the company can be summarized in these sheets, right? In terms of their numbers. And it shows us um, where they stand financially. So if you are taking any business, if you are looking to any business, it might not even be business that you're buying stock in. It can be your own private personal business. Everything about that business has to be summarized in your balance sheet. But one thing you have to know about balance sheet is we usually call it a snapshot, right? It's like taking a picture. Things can change after you have taken that picture. So when you are reading a balance sheet, the first thing you want to check is at what date. So they're going to put it at the top of that balance sheet. Um, they're going to put as at particular date. So that means the snapshot of this company in terms of what they worth financially or where they stand financially is as at a particular date. Things can change the day after we have taken this snap picture, right? So when you are making your investment decision, you have to bear that in mind that it's as at a particular date. Now, in your balance sheet, you are going to have three sections. Three sections basically. You're going to have assets, you're going to have liability, and you're going to have equity. Right. And you can also apply this concept to your personal life. I do it, I apply it to my personal life. It's because I see our lives as a business as well. So you're going to have assets, you're going to have liability, and you're going to have equity. And the basic formula is that whatever you have as an asset and whatever you owe as a liability, the difference or the remainder is your equity, right? So asset talks about what you own, whether it's in equipment, whether it's in goodwill, whether it's in patent, whether it's in copyright, whatever you own, that is your own, it is your asset. And liability is whatever you owe, that is what you have to pay. So if we take your asset and we take your liability and we pay off all your liability, what remains is your equity. That is what belongs to you. That is your own. So, and that is what you are worth. So balance sheet is looking at assets, it's looking at liability, and it's looking at what? Equity. So now, on the balance sheet, you're going to have 5 main sections, right? I talked about assets, I talked about liability, and I talked about equity. Within assets, all assets are not the same. They don't behave the same. They do not appear the same. They didn't get into the company the same way. They're not going to be treated the same way. So for assets, we have two types of assets. We have the current assets and we have the non-current assets. And when you hear current, you should know that current talks about things that move very easily, currency, water current, and all that. So that means it's very close to a liquid form. It's something that can be converted into cash. Cash is the most current asset, is the most liquid asset. So when when someone says I'm not very liquid, that means the person doesn't have cash, and does not mean that the person does not have assets. But those assets that you can quickly convert into cash or cash form, they are referred to as current assets because we can quickly convert them. So, for example, if I have a vehicle, I can capture my vehicle under current assets if I can quickly dispose that vehicle within 12 calendar months. So the accountants in their rules, they also put some guardrails around what currency is all about, because you can say current assets is 1 month, what you can convert in 1 month, 3 months, and all that. But the standard rule is within a year, you should be able to convert that thing into money. So if you cannot convert it into money, it is not a current asset. For example, a piece of land is not a current asset because you may not be able to dispose it within a year. But if by assessment, you feel that it can be disposed within a year or 6 months, you can treat it as current asset. So accountants have their rules around how they treat assets. But for our general knowledge, current assets are those things that you can quickly convert to cash. So when you are looking at an investment, and you are looking at their balance sheet, you want to first of all go and look at what is their current asset like. How much they are, if they have problem tomorrow, what can they quickly convert to cash? If they don't have enough asset they can convert into cash, they might be having some risk, right? So then the next asset is the opposite of current asset, which is non-current asset. These are assets that you cannot easily liquidate. They are still assets, they are still your assets, but you might not be able to liquidate them. It might take time, might take more than a year, 2 years, 5 years to be able to even get a buyer or be able to finalize the process of liquidating it. Sometimes it's not even getting the buyer. The process that you might have to pass through to liquidate that kind of an asset might make it a non-current asset. So you want to look out for that. What is their non-current asset and what is their current asset? Then we go to the liability side. You want to look at the two types of liability. It follows the asset structure as well. You have the current liabilities and non-current liabilities. So your current liabilities are those liabilities that you have to settle within one fiscal year. That is one 12-month calendar year or 1 year of the business. So I need to clarify that fiscal year is different from normal calendar year. Your fiscal year is the operating year for the business. So sometimes the business start the operation say 1st of April, That means their year will end 31st of March, whereas your normal calendar year starts January 1 to December 31st. I think in Nigeria, some years back, CBN made a rule that banks should align their fiscal year with the calendar year so that we know you are starting from January 1 to December 31st, because a number of banks use the difference in their fiscal year to do some accounting and financial engineering. So, but you should know that might not be applied to other companies. So you might be buying companies that their year starts in June and ends in May. So you want to also understand what is their fiscal year, what is their operating year. So any debt that they have to settle within that 1 year is considered as current liabilities. And any debt that takes longer than that is non-current liability. Then you now have the third section, which is the shareholder equity. That is where you see the value of what the shareholders has brought into the business. Because the money that the shareholders brought into the business, which is what they use to acquire assets, right? And in the process of running the business, they're going to generate liabilities. So whatever remains for you at the end of the day, after you have paid all your liabilities, is what we accrue to the shareholders in terms of equity. So we look into all that. So the summary of this is the balance sheet. You are looking for 5 sections. You are looking for your current asset. You are looking for your non-current asset. You are looking for your current liabilities, your non-current liabilities, and shareholders' equity. There could be a lot of other information, but in the balance sheet, those are the 5 sections that you want to focus on. So this is just talking about operating cycle on business. You have the cash in, you have inventory, the make sales, and money comes in, right? That's just the operating cycle. And I also talk about the fiscal year. Now let's look at the asset section of Nigerian breweries. I picked Nigerian breweries as an example here, but when we get down the line, I will use a bank as another example so that we can see how they are slightly different, but essentially all businesses are the same in terms of what they have to report, but their model can be different. So Nigerian Brewery is a fast moving consumer goods company. They produce product like Martina beers and all those stuff, and they sell it and they get money in. That's how many of the businesses are. You have a product, you have your supply chain, and you have your marketing, you have money coming to the company, and the cycle continues. So now this is their balance sheet. Confirm you can see my screen very clearly. All right. So if you look at their balance sheets, you can identify all the sections that I have mentioned. At the top here, we have the assets. At the top here, we have the assets. That is the first section you are going to look out for in your balance sheet. It is the assets. We have to start from the assets. We are not going to start from liabilities. We have to start from assets. And I mentioned that under assets, you have 2 types of assets. We have the current asset and we have the non-current asset, right? We have the current asset and the non-current asset. So when you look at this, the first side, can you see my cursor? Give me a thumbs up. You can see my cursor. All right. Because I want to use my cursor to move around. So if you look at this asset, the total you have here, what they put non-current assets. So under their non-current asset, what they have their property, plant, and equipment. So every machine, buildings, and everything they have, they will have summed everything up, their value inside this line item. Then you have right of use of assets, maybe some other asset that they have the right to use. Intangible asset and goodwill, goodwill in accounting is captured as an asset, all right? It's captured as an asset. So if you have a bad reputation, it is captured in your book. That's why you see company raising to improve their, for example, their carbon emission, their environmental impact, their goodwill, doing corporate social responsibility, anything that makes all the investment you put together into making that name has to be quantified. So goodwill is an asset. All right. So for example, if tomorrow Coca-Cola says, I'm selling the entire Coca-Cola factories to, let's say, one of us here, but they are going to hold the name Coca-Cola. The amount we pay for that name Coca-Cola, it's not just because of the patent, because of the brand and the goodwill they have accrued over the years, can be so humongous that it's enough for you to start another business. So it's not just about the machinery. Goodwill is also right. So you want to check that investment and all that. Whatever is captured under their assets, their non-current asset, they are going to put it here. So you want to look at it. What's their non-current asset looking like, right? Then you have current assets, which is their inventories, their trade receivables, their prepayment, their deposits for invoice, because we believe inventory, you can easily sell it. Even if you have stock in the warehouse, we believe that you can sell it at a discount, you can throw it away, and people just give you some scrap values. So we capture all this under current assets. So if as an investor, when you're looking at the balance sheet, you want to look at what is Nigerian Breweries non-current asset and what is their current asset. So they have some money. I can see 424 billion in terms of current assets. So they have some cash on hand. But the two added together will give you their total assets. When you go to the liability side, right? I jump the equity, I go to liability side. Same thing you will see on the liability side. What is their non-current liability? They have loans that they are servicing. They have lease liability. They have employee benefits. You know, those make up for non-current assets. Then you come to their current asset, loans and borrowing, lease liability, current tax liability, trade provision, and all that. So they have also stated what they recorded as their current liability. So they have about 624 billion naira to pay uh, within that year, right? Then you come to equity, right? The equity now is telling you about the share capital, the share premium, the share-based payment reserve, retained earnings, and all that. This is this is where we call the monies the owner brought into the business, including you and I that are investing in the business, right? So when you see share capital is talking about the capital that they raise per value that is based on the book value, right? Then you have share premium, which is a little more than what its par value is. So, for example, if a company worth 1 naira, let's say for instance, and they, let's say when they were selling the IPO, they give that for 3 naira. That means they raised 2 naira above what their book value is. Their par value can say at 50 kobo at 1 naira, rather, but it's sold at let's say 2 naira or 3 naira. So there's some premium over what the book value is. So that premium has to be recorded somewhere. So they call it share premium. We have some shares that are based on payment reserve. Maybe some of the employees, management have some of the allowances tied to uh to shares. They're going to record it here. Whatever constitutes the ownership of the company, you will see it under equity. And one thing I need to highlight here is that you will see notes. Notes. Anytime you take a financial statement and you're under balance sheets or any of sheets there, you will see notes. This note is where you have details of what goes into this line item. So you want to go to that page where they have notes and read, okay, what are the property, plant, and equipment that they actually sum up into 535 billion. So you will really see it in notes 13A to B in a right issue and all that. So if you come to this share capital now, 24, if you go and read the note, it's going to explain who are the people that own this 15 million shares, sort of. So that's about balance sheet. I think the next slide is talking about liability, which I've already covered. All right. So anytime you take a financial statement, you want to look at all that. Let me move a little faster. So we talked about the equity side, the equity section. Now, the next part of the financial statement you want to analyze is the income statement, right? Because the asset is not really telling you much. It's just telling you what they owe, what they own, and what they worth. But what is actually happening on a day-to-day basis, on a yearly basis in terms of performance, the report that all of us actually are interested in when we are waiting for their end of the year annual report. One of it is income statement. So income statement is also called profit and loss. So if you are looking at an annual report, you might not see it as income statement. They might write it as profit and loss. They mean the same thing. So, and what do you want to check in your income statement? You want to start from the revenue. Where is the money coming from? Right? Where's the money coming from? In fact, it's basically divided into three. Will I say into three? I would say into two, with many things inside. So we've talked about, you've had the word bottom line. The bottom line is, everybody use the word bottom line is. So what is the bottom line? It's actually from the accounting book. Bottom line means your net profit or net loss at the end of the day after you have done all your transaction. That's what you see at the bottom. That's why they call it the bottom line. It's the last thing you will see at the bottom of a financial report. So anytime you hear them saying the bottom line, what they're saying is the last line on the bottom line is still red or green. That is your net profit. Then if you have the bottom line, then you're going to have the other side, which is the top line. So anytime you hear the phrase top line, they are talking about your turnover or your revenue. So the top line here is the top, which is the revenue. And when you go under notes, like I mentioned, note 6 will tell you where all the money is coming from. You know, how much is coming from product, how much is coming from franchise, how much, everything will be recorded in note 6. So you want to take a look at where are they making their money from. Then after that, you now want to look at how they spend the money that came in. Cost of sales, they will tell you what the cost of sales is like. Then you have your gross profit. That's the first margin you will have, the gross profit. Then they have the other expense in terms of administrative expense, selling expense, and all that. Then you're gonna have your loss or profit before tax. Then you're gonna have your final loss or profit after tax. So those are the things we are looking for on your income statement. What is the top line, the revenue? What is the bottom line, the net profit or loss, and every other expense in between? How do they arrive at the bottom line? What makes the bottom line to go down or to go up? They will be explained in between. What is your gross profit? What is your administrative overhead cost? What is your finance cost? All right. And what is your bottom line? So those are the things we are looking for in financial statement. The third statement that you will look out for is the cash flow statement. Now, profit in itself is an illusion, right? Profit, that a company is profitable does not mean that a company is okay, right? A company might not be okay, but they might be profitable. They might have assets, fantastic assets. They might be looking profitable on paper, but they might actually be cash strapped. And that's why they say cash is king. So cash flow statement is what actually tells you whether we have money in this business or not. And what do you want to look at? In cash flow, there are three sections in cash flow statement. The first is the operating activities. How much money, where is the money coming from operating activities? Then the second section is investment activities. What money is coming from investment or going into investment? And the third is the financing activities. How much money is coming from shareholders or from other paid in capital, or loan that we borrow. So you have the operating activity, you have the investment or investing activity, and you have the financing activity. Those are the three sections. Now, in income statement, there are some costs that are registered that we have to be taken out in cash flow statement. And one of it is depreciation and impairment. Because depreciation in itself, impairment in itself, write down in itself, is a non-cash movement. What do we mean by non-cash movement? You are not really, the money is not really leaving your pocket. You are only stating it on paper that, okay, the car I bought 5 years ago or 2 years ago, I'm going to recover the money in the next 5 years. So I bought it for 1 million. I'm going to be taking 200,000 out every year from my profit. Before I can declare my profit, before I can know the tax I will pay the government, right? So they allow you to register that in your income statement. But the truth is that that 200,000 is not leaving your account, it's not leaving your pocket. So when you get to cash flow, you have to add that money back. Cash flow does not concern itself with anything that is not cash movement. And that's why when you are computing tax, sometimes the tax authority they want to look at your cash flow because they know a lot of people play tricks and some engineering around income statement. You can pile in some losses inside your financial statement to tell us, or some expenses to tell us that you are making a loss. But when we actually look at your cash flow, we can know the position of the company. So we have to bring the three together to be able to really assess what is happening in your company. So I need to highlight that cash flow is slightly different from income statement. So how are they tied together? Um, okay, inventory. I won't do much on this because of time. So how are they tied together? What you need to look out for when you are looking at your income statement, the net earnings that you see in your income statement, you will see it in your cash flow under the operating activities. That's how they are tied together. Now, if you look at whatever is depreciation, okay, in your cash, the closing cash in your cash flow statement is going to be registered in your assets under your current asset in your balance sheet. If you look at your depreciation in your income statement, depreciation is somewhere here, 19,500 is going to be added back somewhere here in your cash flow statement. So the three statements are tied together, they are linked together. So when you are reviewing a financial report, you have to look for those linkages and to be sure that there is consistency in their reporting and all that. So let me quickly move to now fundamental analysis framework. I've introduced you to the financial statement, which is one of the instruments or one of the tools that you will use for your analysis. But now fundamental analysis in itself, how do we go about it? There are two approaches. You use the top-down approach or the bottom-up approach. The top-down approach simply starts from looking at what the economy is all about, run your analysis on the economy, then move to industry, you run your analysis on that industry. Maybe it's an insurance industry, you might want to run your analysis on the insurance industry, or move to the company and start to focus on a particular company. But the bottom-up approach is to start from the company to industry to economy, depending on, there's no hard and fast rule. But for the purposes of this exercise, we start from the bottom up, which is to start from the company. So let's analyze Zenith Bank. I'll use Zenith Bank as a case study, and I'll be using their 2024 financial report, not the current one. You can apply the same thing, the correct one, as an exercise, and also apply it to other companies. So what you want to do, step one, is to understand the business in the plain language. That's the step one. When you are running your analysis, you want to understand the business in the plain language. What do they sell? Who are their customers? How do they make money? Where do they operate? And any other question you want to ask around the business. What do they sell? Who are their customers? How do they make money? And where they operate? Once you have your answer, you should be able to phrase it into a simple statement that can tell us about the company. So for example, here I put what Zenith is all about is a leading Nigerian commercial bank offering corporate, retail, SME, and digital banking service, right? How do they make their money? Primarily from interest income on loans and investments, plus commission from transaction, cards, e-channels, and corporate services. And where do they operate? They are headquartered in Lagos. They have branches across Nigeria and they're with some international presence. So in summary, I can say Zenith is a large Nigerian bank that earns money by lending, investing in securities, and charging fees on banking services. You should be able to, in a statement, in less than 25 words, tell us about the company you are putting your hard-earned cash into. What are they into? So if I ask now that Champs, what is Champs into? You should be able to tell us in less than 30 words what Champs into. If you don't know what they are into, then you are not yet an investor. As an investor, you should be able to say this is what this company is into. This is what this company is all about. This is what this company is all about. That's the step one in doing fundamental analysis. Step two is to now read the annual reports and any other investors' materials that they made available. Annual reports, all publicly quoted companies will present their annual report. So, and what do you want to look at? You want to look at their business overview. You want to look out for risk factors, their management, discussion and analysis, their financial statements, investors' position. They're going to pack a lot of things inside their annual report. You want to go through those sections and have an understanding of what the business is all about. There is a lot of information inside their annual report, right? So then, well, most importantly is your financial statement. Then your step three is to analyze the financial statements together. Like I said, they are all linked together. So the first thing is their income statement. Look at their trend over the last 3 to 5 years. Usually when they are preparing their annual report, they will project the past year and the current or the concluding year. So you always have 2 years as a frame of reference. But when you are doing your own analysis, you can query your AI, or get their report and sort of do a 5-year trend of the income statement. Like I said, you start from their top and bottom, then everything in between. So the revenue growth, are they growing steadily or erratically? What is their gross margin like? What is their net operating margin like? So the top line, how is the top line behaving? How is the bottom line behaving? And what is their gross margin? So, so what we want to have a consistent and improving margins, not a one-off spike. And so when you are looking at it, you just want a company that is doing well for a short period. You want to see that they are actually gradually reducing their cost, their margins are improving, their bottom line is improving. So and when you look at the analysis I did for 2024 of Zenith, you see their gross earning moves from 2.13 trillion to 2023 to 3.97 trillion. That's about 6%. So you want to calculate your margins or your ratios. What are they moving up? That's almost 6% within a year. Their net interest income, 736 billion, moving to 1.7 trillion, and all that. These are some of the informations you want to check out or query to have the data with you, right? Then you want to look at what is their net interest margin. That is how much of their profits, what is the ratio of their net margin over their asset or average asset. You want to look at all that as well. Then when you go to see on step 3, analyzing financial statement, then you now want to look at what is their balance sheet like, right? So, and when you're looking at balance sheet, what you want to ask, let me go back briefly. When you're looking at income statement, I mentioned you're going to look at the top line, the bottom line, and the gross profit and everything in between. There, you can compute a number of ratios. You can compute any ratio against their revenue. You can compute any ratio against their net income. You can compute any ratio. You can decide to want to check what is their financial cost against their net profit. You are an analyst. You are looking at your company. So you want to see how much of my profits or how much of my revenue is going into financial costs, into the cost that they pay banks, charges, and the rest. You might want to check that. You might want to check what is the administrative overhead against revenue or against net margin. So you do a lot of ratio computation with your income statement. When you get to balance sheet, same thing, but the question you want to ask now, you want to look at, okay, what is their debt to equity? How much are they owing? We said balance sheet has 3 parts: the asset, the liability, and equity, right? So if I give you money to run my business, I want to know how much liability are you piling up for me, all right? So if you keep borrowing money, I want to measure how much you have borrowed against our equity as shareholders. So that's called leverage or gearing. How much are we geared? Because that will tell me the level of risk we are taking. Because when push comes to shove, we have to pay those debts. And to pay those debts, we have to either liquidate all our equity after we have sold all our assets. So we want to know what is your debt to equity ratio. You want to know what is your current ratio. Your current ratio is the ratio of your current assets to your current liability. Don't forget that as a current asset, you have to be able to dispose within 1 year, and liabilities that are current also have to be paid within 1 year. So do we have enough current cash and cash equivalents on hand that can take care of your obligations within a year? That is what your current ratio is telling you. It is usually preferred for a normal company. I think it's ratio 1 to 1, if I remember very clearly. That is, for every 1 naira you owe, you must have 1 naira to pay. And like I said, we can even apply this to our personal space and personal lives. You must be able to check what your current ratio is. How much can I raise within a particular space of time versus how much I'm owing within that space of time? That's my current ratio. Is the current asset or current liability? Can it add to my short-term obligation? Then you want to look at the asset quality. What kind of assets are they reporting? What kind of assets do they have? So you see that in the balance sheet. For example, when I look at Zenith, we'll be looking at their total assets, their customer deposit, their gross loan. Loan is very important because banks gives loan. You know, how much of bad loans do you have? That's when you'll be seeing them reporting loan to deposit ratio. You cannot risk all our money that we are giving you to give out as loan. But what if you don't pay back the loan and I come in tomorrow, I want to withdraw my money, and you say you cannot pay me my money? We are going to have a problem. So as a bank, I expect you to be conservative enough to be able to, yes, give out loan because that's where you make your money from. But at the same time, you have to maintain certain loan to deposit ratio. Don't risk all the money. And it's one of the things that the CBN is enforcing now, that banks should not put customers' deposit at risk. You have to maintain certain LDR, loan to deposit ratio, and also capital adequacy. That is, how much buffer do you have just in case you go bust? How much cover do you have with the CBN that we can use to cover your liabilities? You know, that is because bank is strictly regulated. So there's a measure of comfort and safety around their risk management. That might not apply to an individual company like, say, NACO or Dangote or Nigerian Brewery or Champs. So you have to look at their balance sheet and start to compute these things and making some sense. That I hope these people are not over borrowing to the extent that one day they will just liquidate the company. So as a fundamental analyst, you want to look out for that, right? Then the third part is your cash flow. So what do you want to ask? You want to find out, you know, is the profit that they declare actually real? Is their cash flow positive or negative? What is their capital expenditure? What are they investing in? Where is investment money coming from or going to? You know, what is their free cash flow? Free cash flow is the money that is left after we have accounted for, we have added depreciation back, we have done all the book adjustment. What cash do they have? Free cash flow is very important in business and even in individual lives. Free cash flow is what you actually use to to I would say to to project lifestyle. Same thing with a company. Is this free cash flow that you can use to make any maneuver in case economy changes or things changes or you see opportunities that you want to take. So some companies might be profitable, they might have very tight free cash flow. So you want to factor that into your analysis. However, for a bank, that is slightly different because I talked about business model, understanding the business model. The business model of a bank is different from a normal company because for them, retaining cash is more of a liability. They don't have products like that they sell. The product they sell is cash. So they have to give that cash out as loan. So their cash flow is likely going to be negative, right? Because if you don't give it out as loan, they're not going to make uh, income, right? That's why for banks, they don't really use cash flow, free cash flow for their analysis per se, because it's going to be a little bit warped, you know. So, but for every other company, you have to look at their cash flow. It's very, very important. You know, I have about 9 minutes to round up. Okay, so the step 4 is to evaluate profitability and efficiency. Now that you have looked at the 3 books, you now want to evaluate what's their profitability like. You want to check their return on equity, how much are they making versus how much we have all put together as investors, which is registered under our equity. You want to check what is their return on assets, okay, how much are they making with all the assets that they have spent our money to buy? How much are they making? How much are they making on their capital employed, which is your EBT, is just earning before interest and tax over total assets. That is like your net profit before you pay tax. How much is it versus your net assets, which is your total asset minus your current liabilities. So you want to check the capital employed and compare it with industry peers. In and of itself, you can compare it with its previous years, but you can also compare it with competitors so that you can say, okay, why should I invest in bank A and not invest in bank B? Some things have to guide that decision, right? Then, so for example, on the banking side, on Zenith side now, you see that they report their return on average equity, which is in 2023, 2024 is 36.6, versus 2023 that was 32, no, 36.6 in 2023 versus 32.5 in 2024, which is like a slight decline. So you want to ask yourself as an investor, why is there a decline? Okay. And then we want to check return on average assets and net interest margin, because they make money from interest income. So you, as a bank, when you're analyzing banks, you are looking at it differently from a normal business. So how much are they making from interest, which is coming from loans that they've given out to customers? And you can see here that they are doing well. They have improved to make more interest in terms of 9.5%. What is the cost of fund? What is their cost of fund, which is the money they pay to get capital? Banks also do borrow money from other banks, from CBN, to be able to fund their operation. So what is the cost to them, versus their earnings? We want to check the cost of risk. That is the risk that they are taking, the loans. What are those loans that they have already estimated that is going to go bad? How much of it that is it against our gross loan? So you want to check their impairment versus their loan. So NPL, non-performing loan. You want to know how much is their non-performing loan when you check it against their loans. Like here they are reporting about 4.7%. It moved up slightly in 2024 to 4.7%, but that's still pretty good. That means 5%, less than 5% of your loans are projected to go bad. That means they can recover all their loans. That's a very good bank. And coverage ratio, just in case the loans go bad, how much do you have to cover that cost to write it off? Here they are reporting about 223%, and that shows that they are in very good position. So they are managing their loan portfolios very well, and they are maximizing their net interest. So these are some of the things you want to check when you are doing analysis of banks or any other company that you are looking at. Step 5 is to assess their financial health, risk, and competitive advantage. Now, this is where you now start to ask some qualitative questions, and looking at their advantage, what's their brand strength, what's their network effect. You also interact with this company. You listen to news. You want to begin to factor everything together into your analysis. What are they doing? How are they behaving? Do they have a competitive advantage? Have they just signed a franchise or a contract agreement, or do they hold any monopoly? What is happening in their space? What is regulations like, licenses like? So you want to do all those analysis. And lastly, you now want to consider their industry and the macro context. Now when you are considering the industry, now this is where we say that now you can ascertain whether they're a good business now up to this point. Now we want to know now whether they are a good investment. Like I said, they are not completely the same thing. Now you now want to start to check, what is the industry growth like? What is their competition like? Then how do we value the company? Then you now start to ask questions like, what is their PE ratio, which is price to earning ratio? Price to earning ratio will tell you what is their price now versus what they are making in terms of net profit. What is it like? So if it is high, it can mean that investors are paying more for what is worth. It could also mean that investors are looking at them as a high growth potential, that there's a future growth that has been factored into the operation. That's why they are willing to pay more for the price than what they are making. If it is low, it shows that they are undervalued, or it can also show that their growth is low. Most times you want to look for those companies that are undervalued, but undervalued in itself is not a complete data point to make your investment decision. You have to look at the whole story around why they are undervalued. So you start to look at PE ratio, you look at their own story or their history of PE ratio, you compare it with their industry average, and you have to look at the growth, right? Now, then you look at something like price to book. Now, so in PE, when you're calculating your PE ratio, you can calculate your PE ratio based on their past record. You can calculate it based on the future value of future revenue you think they can make. And also you can calculate it based on what we call normalized PE. That means you have made some adjustment in the books based on some other factors before you determine your P ratio. But whatever methodology you are using, you have to be consistent when you are comparing with a similar company within the same industry. And it is also important to note that P ratio is not applicable to all companies. For example, if a company is in a negative cash flow, there's nothing you are wanting to measure against. Price against negative earnings, we can't even start to talk. So you might not be able to use PE ratio in that case. For example, a startup company that's still just struggling, you cannot use PE ratio to evaluate whether they are going to be successful or not. So you can't use PE ratio for the evaluation. If a company also has a cyclical movement that their revenue goes up and down, PE ratio might not be very applicable. So instead of that, you might want to do what you call PB ratio, which is price to book ratio, or you want to look at their EBITDA. EBITDA is earning before interest, tax, depreciation, and amortization. So what we are simply saying is that what is their operating profit after you remove all the administrative costs. You have the gross profit, then you remove all the administrative costs and everything. Before we start to talk about interest, taxation, depreciation, what is the real profit that we can say is coming from the business? You might want to measure them against that. You can want to measure them against EV, what we call enterprise value. Enterprise value is just looking at, okay, what is their stated market capitalization, but now you are going to factor in their debt and their cash, into your evaluation. So there are different tools you use. Then you can also do what we call discounted cash flow, where we look at this company in the next 5 years, how much are they going to make in terms of cash flow, in terms of free cash flow, how much are they going to make? Then you discount it back to today using some discounting factor to see whether they actually whether they have some intrinsic value. So a company from your analysis can be generating more money in the future, that you feel that if you discount it today, it's worth investing in. And like I said, AI too has made life very easy now. You can run this with AI, to help you compute the discounted cash flow for a particular company instead of you. It's a whole lot of rigorous mathematics, But with AI too, you can easily do it. But what you want to make from it is this company undervalued as a potential for my investment, or is it overvalued that I need to watch or cut my loss or reduce my stake inside it? Those are the questions you want to answer when you are valuing a company. Is the company valuable? Someone like Warren Buffett likes to invest in companies that are undervalued. So he plays a very long time game. So he holds stocks for a very long time, 10, 20, 30, 40, 50 years. So once he does his analysis and he finds that they are undervalued, takes his position inside it and work with the company to actually improve on their value. And over time, it has paid off. So you want to check their valuation. For example, I put example of the Zenith on the other side here. You will see how I can say they move from not just being a good company to a good bank, right? You look at their P ratio, you look at their PB ratios, you compare them with their competitors, GT, Access, UBA, and the rest. You look at their return on equity, their capital adequacy ratios, which is approximately 25%. So, and if you do your discounted cash flow on them, you can really say as an analyst that it's a company that is worth investing in. Sometimes you might use another model for discounted cash flow. We also have dividend discount model. That is how much dividend they are going to pay into the future. Then you discount it today and see that, oh, it's worth my investment for future dividend today. If I invest today, the next 4 years, 5 years, 7 years, 10 years, I'm going to get more dividend that is worth more than what I invest today. Okay, then you analyze the company. So after you have done all this analysis, you now have to, as a fundamental analyst, have a clear thesis, and what are you going to answer? Why the business is a good business, whether the stock is well priced, or what could go wrong and when you can sell. So I put something together here for Zenith that I ran the analysis on and say, okay, Zenith is a highly profitable, well capitalized Nigerian tier one bank with a strong digital capabilities and a return on equity above 30%. Asset quality is acceptable within the non-performing loans under 5%, under 5%, and coverage above 200%. The main risks are Nigerian macro and regulatory uncertainty. If the stock trades at a discount of price to book or price to earning versus peers, despite superior profitability and capital, it may be undervalued for a long-term investor willing to accept Nigerian specific risk, right? So I put this together. So if you look at all the slides I've been coming up with there, everything I pieced together here are coming from all those analyses. I've checked their ROE. I've checked their capital adequacy ratio. I've checked their price to earning. I've checked their price to book. I've looked at their top line. I've looked at their bottom line. I've done qualitative assessment of the regulatory environment or the macro environment. I've compared it to their peers, and I can say in a simple 7-line or 8-line paragraph that this is the reason why I'm investing in this company, and this is why it might be recommended. So that is what a fundamental analyst, that's what it does. It looks at all this analysis and put it together in like this. So when you do industry analysis, there are about 10 questions that I crafted down here that you can query research on the internet or query AI to provide to you to give you the information about the industry. What exactly is the industry? The boundaries, how big is it, how fast growing, the competition, the regulation, the external forces, the major players, the trend disruption and all that. Then you want to check the economy entirely. Okay, how fast is the economy growing? What is happening with our inflation? What is the central bank doing? What's our fiscal position? What is the labor market telling us? Is the currency stable? Especially if you are in diaspora and you are investing in Nigeria, for instance, you want to say what's the currency stability? What is the trade and external balances? Or you want to invest in other economy? Maybe you want to invest in Hong Kong. You want to check all these things and check their economy. So putting everything together as a fundamental analyst, what you want to do is, one, start with the business model. Two, compare financial performance, income statement, compare balance sheet strength, compare cash flow equity, compare profitability ratios, compare risk profile. 7, compare their competitive advantage. 8, compare valuation metrics. Then lastly, compare growth potential. Once you're able to do all this now for a given stock and a list of stock, you can be comfortable and confident of your investment. And you can say, yes, you are an investor that is driven by fundamental analysis, or you are a fundamental analyst, and that way you have a better grasp and understanding of your investment. And that is the end of my presentation of this session. Thank you. Let me open the floor 2 minutes for questions before we call it a day. Any questions from the audience? You can open your mic and ask your question directly so that we can. Do we have any question before I call it a day? All right. If there's no question, I know sometimes this can be overwhelming. When you take time to listen to the recording again, if you have any question, you can ask me. You can chat me. I will respond to it. But it's a journey. It's not something you can master in a day. But if you consistently develop yourself, pick one stock and do a comprehensive fundamental analysis on it, then you apply it to another stock, you will be more comfortable and confident when you are investing. So that's the whole story that I have today. Thank you. If there's no question,
Thank you
I will
very
call
much.
it a day. Yeah, you're welcome, madam. So I will call it a day. I'll call it a day. So next session, we'll be looking at technical analysis, and that's where we now start to look at some technical matters, you know. All right. But it's promised to be interesting too. Okay. Let's have a safe day. Thank you for your time.
You too. Enjoy the rest of your day. Bye.
Thank you.
Thank you very much, Koshi.
You're welcome, bro.